been adjusted for some one-time effects in the corresponding quarter last year, that also returned to growth. So it's a very healthy quarterly performance, building on the momentum that we started to see in the second half of the year. What's gone very well in the year has been the growth that we've seen in our large molecule manufacturing business and the recovery that we've seen in our discovery services, both of which are exiting the year with strong momentum. A challenge has been in the small molecule space, but again, we've seen in the second half of the year, we've seen a good number of customer engagements, and we see that taking momentum through into the next year. A real highlight for the quarter has been the acquisition of US large molecules biologics facility in Baltimore. Strategically, that's very important for us, building on our capabilities to play into what is the fastest growing part of the global CRDMO market, which is large molecule biologics manufacturing. That acquisition positions us very well to play into that market. And of course, it gives us a strategic foothold in the United States market itself. So it's worse.
So, Mr. Vince, now the concerning point for investors is, so many investors were actually expecting Syngene would come back to double-digit growth, maybe from FY26 or 27. But now the outlook which has been given by the management is that the revenue growth will likely be in mid-single digits because of the new biologic facilities, which will actually increase operating cost and depreciation for the company. Just wanted to have your view when Syngene can see the double-digit growth which we used to have in the past.
Sure. So let me break down those questions a little bit. So for fiscal 26, we're guiding a reported revenue growth in the mid-single digit. On an underlying basis, our expectation is broad-based growth in the early teens across all three of the major platforms. So that would be our discovery services platform, our large molecule manufacturing platform, and our small molecule manufacturing platform. So on an underlying basis, we're expecting growth in the early teens there. Now, let me explain the difference there. The difference is that we are also factoring into 26 impact of a client inventory adjustment on commercial supplies in large molecule manufacturing. So we have a client, we've been supplying commercial product for them for their global launch. And as is completely normal in the pre-launch to launch phases, the supply requirements build up, and post-launch they begin to normalize. And we're going to see that effect play through with that client in 2026. But if we adjust for that, the fundamental underlying growth across all three of our businesses will be in that early teens range. Now, you also mentioned that the
double-digit growth. So when can investors expect the double-digit growth from Syngene? Maybe from FY27?
So I think that, as the inventory adjustment plays through, that we would expect that to wash out in 27, and then the more fundamental underlying growth to emerge, and we'll guide on that later on in the year. It's too early to call, but fundamentally we would see strong momentum flowing through.
Understood. Also, Mr. Vince, just wanted to ask you a question on that. There was a concern about has Syngene lost any customers because some of the customers have switched, to their captive centers. So any update that you can give?
No, I think we're building a broader and deeper customer base. We're seeing a lot of inquiries coming in from customers looking to rebalance their supply chains, and of course the impact of the China Plus One the emergence of capability centres in England, I beg your pardon, in India, we see as a positive. What this will do is grow the ecosystem of life science in India, and that's an opportunity for us.
All right, so that's the management of Syngene. Stock under tremendous pressure today on the back of those numbers. Stock down as much as 9%, 10% as we speak. But let's stick to earnings, and we've got Hindustan Unilever that we've been focusing on all of this morning. In fact, numbers came through not too long back. It has given up quite a bit of the gains that it had. It was up about 1.7% at one juncture. It's down now about 0.5% or so. More details will come through over the course of the next 15 to 20 minutes as the management speaks to reporters, and we've got Mahima at the event as well. But I'm joined right now by Priyam Tolia, who's a senior research analyst at Axis Securities. Priyam, thanks so much for taking the time. What did you make of the numbers? The initial take was that it's in line with expectations. The segment revenue has come through, and it appears as if foods is not doing particularly well. What's your initial take?
So definitely the numbers are in line with our estimate in terms of revenue as well as on the EBITDA front. Particularly if you see from a segmental perspective, so foods, yes, it has been laggard. So food, they are actually facing challenges since last many quarters, especially in the inflation in the tea category, and also in terms of the overall health food drinks, right? So overall consumption demand continues to remain in the HFD portfolio. And again, the tea portfolio, they are gaining the market share in terms of the tea, but if you see from the inflation perspective, the margins continue to remain weak in the overall food categories.
Okay, margins continue to remain weak. So, but overall, you're saying that this is in line with your own expectations, and so therefore, looking forward, Priyam, what would be the factors that you would watch out for? We're going to hear the management speak very soon. What are the key areas that you would be focusing on in terms of the commentary? Because largely we're talking about, or they're saying that they're going to focus on that volume-led growth, which means that maybe you're going to likely see continued depressed margins, right? That, I guess, is the base assumption at this stage?
Yeah, so if you see from the guidance perspective, management has given a guidance of they will be able to deliver EBITDA margins of 22 to 23%. Right, and on the overall demand perspective, what we are seeing from the FMCG as well as the overall consumption perspective, the worst is behind for the sector. So if you see from a rural perspective, right, the rural continues to remain on a recovery path. Also, apart from that, the normal monsoon outlook plus the tax benefit from the tax benefit is likely to play out. So what we believe is that the second half would be, we can see a major recovery in terms of the overall consumption perspective. From the management commentary side, we'll have to see what management comments on the urban recovery side. So it's a big challenge. So in this quarter, we anticipate that the urban is likely to remain weak, but from Q1 and Q2 onwards, we could see some recovery over there.
All right, a final take, and I heard you say that the worst is over, and so therefore the question arises, a lot of people are saying maybe FMCG is not what you would pick in the broader consumption universe, and you're going to have to wait for a little while for those numbers to really take off, if at all. So would you say that at these valuations, because HUL has not really moved anywhere for quite a while, would you say that investors can perhaps now look at picking it up?
Yeah, so if you see from the last 1 or 2 weeks back, if the investor wanted to make a position in the FMCG or the consumption space, they would have won a better return. But we anticipate that given the valuation is slightly now have been lower or in line with the 5 years average. So it's still, we'll have to see the sustained recovery in terms of the overall top line as well as the bottom line. So one should anticipate 10 to 15 kind of a return in large caps universe in terms of FMCG. But if you see from a smaller companies, one can earn a better return over there.
Okay, all right. And we'll come to you at a later date to get your view on that. But Priyam, thanks so much for joining us this morning. Pleasure speaking with you.
Thank you.
All right, let's jump back into Ask Profit. And this, by the way, is where we get all of your questions answered. And based on what you've seen over the last 24 hours or so, I'm pretty sure that you've got questions on stocks that are in your portfolios. The number at the bottom of the screen is where you can call us, and there's a number on the top of your screen where you can send us messages. And let's in fact introduce the experts that are going to be answering your questions today. We've got Kush Bora, who's the founder of kushbora.com, as well as Neerav Ashar, who's a head equity research analyst at Latin Manharlal. Neerav, as well as Kush, thanks as always for taking the time. I'm going to jump straight into it because we're already a little late. The first question is coming through from Angel, who's writing in from Mumbai. She's asking about the technicals on Hoodco, which she's got 1,000 shares of, which she's bought 1 week back at a price of 217. She's in the green. The stock is currently trading at 231. Kush, first question to you. Would you hold on to this or would you book?
Hi, Alex. No, I would continue to hold on. The stocks had a good run. The consolidation that you're seeing in the last 2 to 3 sessions is par for the course after a sharp up run. So I think you should continue to hold on since she's already in the money. It's a good idea to have a trailing stop loss. So keep a trailing stop loss around the 223 mark and hold on the upside. You could very well see the stock hitting the 242 mark, and once that is taken out, perhaps 250 as well. So it's got good momentum going for it. Hold with a trailing stop loss.
Hold with the trailing stop loss is the call on Hoodco. The stock is up as much as 11% over the last month or so. It's had quite the run. Let's talk about red tape. And this is also a shorter term question, and it's coming through from Manish Gupta, who's writing in from Faridabad. He's bought at levels of 180 and he's looking at a 3-month time horizon. Or rather, he's looking at a 6 to 9 month time horizon. He's asking whether or not it will cross the 200 mark. It's quite a long shot at this stage. Kush, what's the view?
Well, I'm afraid, at least technically it doesn't really stand on a very solid ground because, if you look at the weekly setup, it's got a falling channel, resistance that it's looking at from a near-term perspective. The 20-day moving average itself around the 148, 146 mark is proving to be a stiff resistance to cross. So my suggestion would be to hold on with a tight stop loss near the 137 zone. And if that's broken, perhaps you can push it down to 135 for volatility. But as the stock moves higher, closer to let's say 155 and then about 165, I think you should start exiting. It's not got too much going for it just yet.
Okay, not got too much going for it just yet. Tamil Selvan, regular viewers asking about Tata Technology. Actually, you know what? This is another shorter term technical question. So let me take another one. Sigachi Industries. Neerav, this one's for you. The name of the account, of course, I've already told you, Sigachi Industries. Niva from Chennai has got 250 shares, which he's bought at levels of 52. Can it be held for a period of 1 to 2 years? And what would be your target based on your anticipation of the fundamentals?
Well, I think the stock has seen some correction in the recent past, and I think we can expect a modest upside with a medium-term horizon. So I think the immediate targets would be close to 75 to 80 if we are able to see an improvement in the financial performance.
So that's the view on Sigachi Industries. All right, let me go to Tamil Selvan's question. He's writing in from France, as he normally does, and he's got a question, as I said, on Tata Technologies. He's looking at adding at a price of between 710 to 715, and he's looking further to buy at 690 levels if it dips again. He says that his stop loss would be below 677. He's looking at he's asking rather for a short-term target, and also he's looking for the Q4 results. But he's planning to invest or deploy as much as 50,000 rupees. Kush, is this a good idea?
Well, I must say, that's a very detailed question,
Yes.
with all the levels very cleared out on the way up and on the way down. So, very well framed question, I must say. Look, it's not a bad idea to start considering, an investment in Tata Technologies. The reason being the stock had a sharp fall, from listing. After that also, after a brief period of consolidation, it's had a, fallen off the cliff kind of a fall. Now you're seeing a double bottom formation in place. Volumes on the way up are picking up. The stocks crossed the 20 and the 50-day moving average. So I think it's got a few things going for it. Not a bad idea to accumulate some around these levels as well, and then perhaps to consider adding more if it dips to 710, 715, his accumulation zone. I think on the way up, you could look at targets of 765. That's the first resistance band, and once that is taken out, 810. So these are the two levels that you should look for as targets on the upside.
Okay, I do want to point out fresh developments coming through. Of course, there are tensions on the border with Pakistan after the attack that took place, the dastardly attack. And then the latest that we're seeing on the screen, of course, we're waiting for further details to come through, but seemingly reports coming from NDTV are that a joint operation of Indian Army and J&K Police is underway. There has been a fresh encounter. And this is something that has resulted in the death of one soldier. Of course, there has been quite a bit that has already been announced on the diplomatic front in terms of bringing Indian representatives in the Indian embassy in Pakistan back to India and asking Pakistan representatives to leave the country, giving them time to go back to Pakistan. And there's a lot more that will also emerge in the coming hours as an all-party meeting takes place to consider the response to the attack that took place not too long back in Kashmir. We'll bring you more details as and when we get them. For now, let me turn to our next caller, and Dheeraj is calling us from Hyderabad. Hi Dheeraj, how can we help you today?
Good morning, sir. My query is regarding Tata Communications.
Yes, please go ahead.
I bought it just today, like at 1,567 rupees, 130 shares.
Okay.
So recently there is a reiterate from CLSA that the target is 2,100. So could I accumulate more or hold or sell? Is my query.
I got your question. Would it be for a longer term that you're holding this?
For the next 1 quarter, sir.
Only 1 quarter. So you're talking about 2001. I don't think that they're talking about 2,100 targets for the next 1 quarter.
I guess it is in the next 1 year, but I would like to hold it for 1 or 2 quarters.
Got it. Okay. So, but since your question is based on a report that you read, let me go across to Nirav on the fundamentals, because we saw the numbers come through, Nirav, just a short while back. If I remember correctly, it wasn't too bad, right? So would you say that you can hold on, and what are the kind of upside potential that you say is possible over the course of the next couple of quarters?
Tata Communications was an ordinary set of numbers, which was helped by certain extraordinary items. So I think I would really advise that if he should shift to something better like a Bharti Airtel, or something which has got more stable and consistent growth prospects.
Okay, fair point. And when you say Bharti Airtel, I just want to follow up on that. You're saying that it can be bought at the current juncture. I think a lot of people are looking at that. A lot of foreign investors also seeing value in Bharti Airtel as things stand right now. But what is the potential upside that you see?
Yes, I think from our study, basically Bharti Airtel has been a very resilient performer. Even in tough market conditions, the stock was able to hold on, and we've seen ARPUs have been going up consistently. There are a lot of other businesses which are doing quite well. So our target for the stock is around 2129 for with a 1 year horizon.
Okay, 2129 is quite the upside that you see. It is, after all, the leader in terms of average revenue per user, and so that's certainly a metric that is tracked by a lot of people. Of course, we'll see results from Jio not too long from now, later, in fact, in the week on Friday. Is when you will see it. But let's take the next question. Hari from Chennai is asking about SG Mart, which he's bought an average price of 365. He's got an investment horizon of 3 years. He's wondering whether to hold or to sell this. And he's asking from the perspective of this being part of the APL Apollo group. What's the view on this one, Nirav?
Well, I think at this point of time, it's better to be invested in the large cap stocks, because we are seeing a very good value emerge in the large cap stocks. So I think whichever sector we are going into, it's better to be in with the leaders or the large cap ideas. Because valuations have been very compelling, so I think it's better to shift to some better quality names going forward.
Couple of them.
I think one can look at better quality retail plays which are listed.
Like?
One can look at a DMart or a Trent from a medium to long term perspective.
Okay. All right. Point well made. Let's take Dinesh's question. Dinesh is calling us from New Delhi. Hi, Dinesh. Good morning. How can we help you today?
I'm holding 50 shares of Coforge, which were bought when the results were announced 3 months ago.
Sure.
And I bought it at 9088 to be precise.
Right.
And currently I'm suffering a loss of 83,822.
Right.
Now, should I hold on? Should I consolidate, accumulate more, or because of IT meltdown and tariff war?
Yeah.
Should I switch and arbitrage to some other share?
Okay. Dinesh, help me understand, when you bought it, and it's not too long back that you bought it, you've unfortunately borne the brunt of the kind of crash that you've seen in IT as a whole. But what was the time horizon that you had in mind when you bought it?
About 6 months to a year.
Okay, so relatively short term. Kush, I'm going to come to you in this one for strategy then, because he's bought at slightly elevated levels, and he's wondering whether to switch to something else. And IT as a pack has done incredibly well. There is resilience even today. So would you suggest a switch?
So for now, I would suggest, he hold on to this, the Coforge. The reason being that, we are seeing some kind of a revival. Now, my only caveat here is that, this is the expiry week, and we've seen funny things happen in expiry week, right? So I want to just be doubly sure that this is not just an expiry play and it continues to play on, even tomorrow and then, in the following days to come. And that's why what I would suggest is continue to hold on. As you rightly said, in the last week or so, there's been a very sharp uptick on, a lot of these IT names. While I don't think the IT sector per se is out of the woods yet, but this could prove to be a very healthy bounce that could sustain for some time, and a consolidation with a positive bias is on the cards. As far as Coforge goes, I would suggest hold on. 7,200 should be your tight stop loss. That's the 20-day moving average, and you should continue to hold Coforge with that stop loss. Not sure if 9,000 his buying price would be seen, relatively soon. So the idea would be to keep booking profits along the way as the stock moves up. Let's say closer to the 7,900 mark, then perhaps the 8,300 mark. So that's how I would play it. Hold with a tight stop loss and keep booking as the stock moves higher.
Okay. All right. So that's the view. I hope that answers your question. I won't keep our next caller waiting because she's calling us from Kuwait. Vanita, thanks so much for calling us. How can we help you today?
Good morning, sir. This is Vanita Bala here.
Yes, please.
I bought 2 shares. First one is Ceslon. I bought it for 60 rupees a share. 1,000 numbers I got for a 3 months duration. Should I add up more, or I can just wait for another 3 months for it to go?
Got
and
it.
how the growth would be.
Got it. All right.
Second one.
No, let me stop you there, Vanita, because unfortunately we can only take one stock per viewer. So let me get your view on Suzlon. You've got a 3-month time horizon, and so therefore it's a trading view that you're looking for on the technical levels. Let me go to Kush on this one. 60 is more or less where the stock is at right now. What is the upside potential for a period of 3 months?
Sure. So, Alex, first the view is hold because the stocks had, its round of correction, consolidation, and then a rebound. So right now the zone at which the stock is, which also happens to be a buying price, close to the 59.60 mark, that's a bit of a resistance zone for the stock, has been for the most part of this year. So continue to hold, keep a stop loss around the 57 mark. Now, as far as on the upside, in the view on the upside goes, I think the stock is quite poised to move to levels of 65 and then 69. So I would continue holding on to this one and keep trailing my stop loss.
Okay. All right. For joining in and getting that question to us. Kush, thanks so much for answering the question. Do stay with us. We have to slip into a very quick break. We've got more on the other side, so do stay tuned.
That's huge. That is a biggie. It's out of there.
Gold Plus Clear Glass. पार हो या नियर, सब कुछ दिखे clear.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to around.
में रखकर एक्सपांड और अपग्रेड करना होगा. हमें अभी से फ्यूचर रेडी बनना होगा. स्टील इंडस्ट्री के इस ग्रोथ पोटेंशियल में एम्प्लॉयमेंट जनरेशन की, रोजगार के अवसर की अनंत संभावनाएं हैं. मैं प्राइवेट और पब्लिक सेक्टर दोनों से आह्वान करता हूं, आप नए आइडिया डेवलप करें, उन्हें नर्चर करें और शेयर करें. मैन्युफैक्चरिंग में, R&D में, टेक्नोलॉजी अपग्रेड में हमें मिलकर आगे बढ़ना है. देश के युवाओं के लिए ज्यादा से ज्यादा रोजगार के नए अवसर बनाने हैं. साथियों, स्टील इंडस्ट्री की विकास यात्रा में कुछ चुनौतियां भी है और आगे बढ़ने के लिए इनका समाधान करना भी आवश्यक है. रॉ मटेरियल सिक्योरिटी एक बड़ी चिंता है. हम अभी भी निकेल, कोकिंग कोल और मैंगनीज के लिए आयात पर निर्भर है और इसलिए हमें ग्लोबल साझेदारियों को मजबूत करना होगा. सप्लाई चेन्स को सिक्योर बनाना होगा. टेक्नोलॉजी अपग्रेड करने पर फोकस करना होगा. हमें और तेजी से एनर्जी एफिशिएंट, लो एमिशन और डिजिटली एडवांस टेक्नोलॉजी की ओर बढ़ना होगा. एआई, ऑटोमेशन, रिसाइकलिंग और बाय प्रोडक्ट यूटिलाइजेशन स्टील इंडस्ट्री का भविष्य तय करेगी. इसलिए हमें इनमें इनोवेशन के लिए अपने प्रयास बढ़ाने होंगे. हमारे ग्लोबल पार्टनर्स और भारतीय कंपनियां साथ मिलकर इस दिशा में काम करेंगे तो इन चुनौतियों का और तेजी से समाधान होगा. साथियों, आप सभी जानते हैं, कोल आयात, खासकर कोकिंग कोल आयात का असर कॉस्ट और इकोनॉमी दोनों पर पड़ता है. हमें इसके ऑल्टरनेटिव तलाशने होंगे. आज DRI रूट और अन्य आधुनिक टेक्नोलॉजी उपलब्ध है. हम इन्हें और बढ़ावा देने का प्रयास कर रहे हैं. इसके लिए हम कोल गैसिफिकेशन का भी इस्तेमाल कर सकते हैं. कोल गैसिफिकेशन के जरिए हम देश के कोल संसाधनों का बेहतर इस्तेमाल कर सकते हैं. आयात पर निर्भरता कम कर सकते हैं. मैं चाहूंगा स्टील इंडस्ट्री के सभी प्लेयर्स इस प्रयास का हिस्सा बने, इस दिशा में जरूरी कदम उठाएं. साथियों, एक और अहम विषय.
Okay, so the Prime Minister speaking at the India Steel 2025 event and exhorting steel manufacturers to participate in India's growth story. There's a lot to talk about, of course, from that event, and we'll bring you updates through the day, not least of which what the Prime Minister is speaking about. But let me go across to Sunil D'Souza, who's Managing Director and Chief Executive Officer of Tata Consumer, to speak about their numbers. Mr. D'Souza, thanks so much for taking the time. The street has looked at the numbers. A lot of people, a lot of analysts already saying that the numbers were in line with their expectations. But some of the details that you've already disclosed in terms of the implication of inflation in tea how much has been passed through in terms of price increases, and what the mix is in terms of the volume. So let me start with that. Seemingly, there's a pickup in demand in the lower end of the spectrum. Do you expect that that's the trend that will continue heading into the new financial year as well? Or do you see a slight change in that as consumption picks up?
So a couple of points on that. I mean, first of all, I think we were quite pleased with the results that we declared. In fact, EBITDA numbers, I think, were better than what we thought we would deliver. And that's because we saw volume growth across. Top line was good, 17% total, 12% organic. We've had volume growth across all our businesses. Even tea was 2% volume growth, salt 5%. International overall for the year was 5% top line. RTD, which was a problem in the beginning of the year, we delivered a 10% top line. The US is back on 4% revenue growth. So overall, I think we're in a decent place. EBITDA was the one place where we were negative 1.1 versus last year for the quarter. But if I add back, if I take out the tea cost and price increases that we've taken, then actually our EBITDA margins have improved by 80 bips. I would have delivered a 16.1 for the year versus the 15.3 of last year. So we would have actually improved versus where we have actually softened this year. And that's primarily because of the tea prices. About 30% of the cost for the full year has been passed on. We're passing on gradually. So for the quarter, it was 50. For the full year, it was 30. And here's the thing on what happens in a typical commodity when prices go up very sharply. Normally, there is a bit of down trading. And if I dial back 6 months back, or maybe about 4 months back, we did see a bit of down trading happening. The lower end, our mass portfolio growing far faster than the mid to premium. But now, as we come towards end of quarter 4, we've seen growth across all the segments. I do think if there is a normal crop, which I mean right now seemingly looks like for this year, then as supply normalizes, I think we will see a moderation in tea costs, and therefore I would see a sort of benign pricing environment overall for the year. We will take a little bit of calibrated pricing, but not as steep as what we took last year. And therefore, I would see all the 3 tiers, mass premium, and premium, all coming to play. So overall, we remain pretty confident about getting both volume and revenue growth. Revenue, we've guided for a double-digit top line, and margin expansion and EBITDA margins growing ahead of the top line.
Great. Thanks for that clarification. Mr. D'Souza, just a follow-up on that then. Assuming that what you're saying on the cost of tea comes true, the pricing, as you've pointed out, you might still have to do some action. Will that take place in the early part of the year, or will you have to spread it out over a longer period?
I would say we would have to probably spread it out on a longer period, for a very simple fact that it is a fine balance, right, between delivering margin, top line growth, maintaining market share, and a competitive position. And we've got to be very, very careful about it. That's one of the prime reasons why we've only passed on 50%, and 50% we've still decided not to pass on, and it's hitting the margins. So it's a calibrated approach that we would take, number one. Number two, raw material prices can be volatile. Last year, we didn't expect the tea price. When we started the year, we didn't expect tea prices to go up so sharply. So if we have ups and downs, we will react to those ups and downs as we go forward into the next year.
Okay. Mr. D'Souza, good morning. This is Hira on this side. So when you talk about the price hikes in tea and salt, both of that is what you're passing on to the consumers on the back of the cost inflation. Taking that into consideration, when are you expecting the profitability to then improve? Because now the price hikes, as you're saying, will be limited.
So number one, for salt, we took a price increase, I think, about 6 months back. And despite that, we've delivered a 5% volume and a 13% revenue growth. So we remain pretty confident about salt. As of now, we don't see a big move in salt prices. And therefore, currently, we don't see a reason to take salt price increases. We would drive volume growth and top line growth on the backs of the price that we've already taken, and of course the portfolio expansion that we're doing, the premiumization of salt that we're doing, we would focus on those pieces. Margins per se, as I said, if I had netted off tea cost and price from last year's numbers, FY25 numbers, my margins would have been up by 80 bips versus FY24. And therefore, in the coming year, we do expect to see margin expansion. We've guided for 50 to 100 bips expansion in the short term, and we remain committed to that.
Right. Mr. D'Souza, the other aspect is with the kind of recent acquisitions that the company has done, the clear signal that the street currently is taking is the aggression that the company has to build a high growth F&B portfolio. Now, with everything said and done, growth business scale up, premiumization in the India business, that is going to be key to see sustainability with regards to margin gains and to reduce your dependence on the core business, which is nearly around 25% of your portfolio now. What is going to be the strategy from here on?
Tata Consumer, we've always said we want to be a premier FMCG, starting with F&B now, but a FMCG business which will deliver good financial metrics. We will grow both organically and inorganically. And I think we've demonstrated that as well. We've done 6 transactions in 4 years. And it's not that we've lost focus on the core. Despite doing the acquisition this year, for last quarter, for example, we've delivered a top line of 12% organically. And if I add the acquisitions back at 17%, the good part is we've got a pretty good portfolio mix today. So we've got 3 distinct pieces in the portfolio. A is my steady margin business, as you called in, the mid single digit growth businesses, mid to high single digit growth businesses, tea, salt, and international. They're delivering steady margins for us. Then we've got a very high growth, slightly lower margins in terms of ready to drink and sampan. That's the top line play for us. And then we've got these businesses which are very high growths, relatively lower TAMs, but significantly accretive margins, which is Soulful, Capital Foods, Organic India. So the good part is we've got a portfolio mix which is right up there. I think the key piece is now to focus on delivering growth with these three pieces of the portfolio focused on 3 levers: distribution, branding, and innovation. And we remain committed on all these 3 pieces. Distribution, we are now at 2 million direct reach, 4.4 million numeric. We've continued to power the businesses. Our A&P continues to be in the 7.1 to 7.3, 7.5 range, which is a comfortable range for us. And innovation, I would say we're almost best in class at a 5.2% to sales.
Sir, one of the points that you just made, and you've given us the whole gamut of the strategy going forward, but I want to focus on the inorganic growth. And the reason I want to do that is I want to clarify, is that the reason why you are seemingly bolstering the cash that you have? Is that a war chest that you're building that you will deploy? And can you give us some sense of how you're going to be utilizing it?
So let me say, we've always said we will grow organically and inorganically. We will, if we see the right options in the market, we will definitely go after it. As I say, what we like is not for sale. What is for sale, we don't like. So that's the only reason why we're holding back. We were sitting with close to 3,000 crores of cash, but we went after significantly larger targets. And we did do a rights issue last year to make sure we are financially structured right. Again, we've got about 1,800 crores of cash on the balance sheet. Right now, we're focused on making sure we button down the 2 acquisitions that we've done of Capital Foods and Organic India. I think we're doing a decent job. The growth businesses, as I say, organic growth businesses, which we already had, grew by 24% last quarter. If I add Capital Foods and Organic India, they're 66, and we've guided for 30% of our business coming out of growth businesses, which will grow at 30%. So that is very clear. Going forward, I mean, once we settle down Organic India and Capital Foods, if there is value accretion that we see with the inorganic asset, and it has to fit both strategically and financially, there's no reason we would shy away from that.
Mr. D'Souza, your view in terms of Starbucks, I mean, almost a sales growth of around 6% on a year-on-year basis. And this is despite 6 new store additions that we've seen, which takes your total store count to almost around 479, if I'm not mistaken. This does somewhere indicate a negative same-store sales growth, in my opinion. Are you expecting further weakness in the near term? And if so, what is the strategy to improve this?
So overall, if you look at it, the QSR segment in India has been under a slight bit of stress. Overall discretionary spending has been in stress, and therefore you would see that action across all the different players in the market. And Starbucks has not been a complete outlier on that piece. The good part is where we had close to double-digit same-store sales growth in the beginning of the financial year, we've almost come to a zero. So by both macros improving as well as actions which the team has done, including activating different events, celebrating 100 stores in Mumbai and making a big event out of it, activating the classic menu, which appeals more to the Indian consumer, both in terms of price and value, as well as taste. I think multiple factors at play. For the full year, we've still added 58 stores. We are now in 80 cities across the country. We are the largest coffee chain operator now in India with 479 stores. So we feel pretty good about where we are, but we remain committed to the FY28 goal that we set out of 1,000 stores in India. I do think India coffee, both in home as well as out of home, is a secular opportunity which will be there for a few years, and we've got to take full advantage of that.
Just a quick clarification on that. Then the indication or the interpretation that you're going a little slower on store opening in Starbucks is incorrect?
No, it is correct, because we have, I mean, let me say, I like this saying from an earlier boss of mine who said emerging markets is a snake in a pipe. The pipe is directionally pointed upwards, but the way the snake moves, there is a bit of yo-yos, and we are seeing a bit of that. And we will calibrate in the short term ups and downs depending on what we see in the macro environment. We opened 58 stores for the year. We would have liked to open more if the going had been very good. We tempered it a bit, but longer term 1,000 store number remains.
You've tempered it a little bit, and taking those cues into consideration, Mr. D'Souza, I know, I mean, valuations is not something that I should be asking you or talking to you about, but clearly the street has given Tata consumers a rich valuation. Now, this clearly leaves the company very little room for execution missteps. Any commentary on that front as to how targeted it could be, taking into consideration the kind of urban slowdown that still is on the cards?
So let me answer your question on urban slowdown first, right? Actually speaking, if you look at my general trade alone in isolation, rural grew by about 7.2% and urban grew close to 2%. But here's the thing, I don't address the urban consumer through general trade alone. If I add back my modern trade, which is primarily urban, and if I add back my quick com, which is primarily urban, and just take a number saying 50% of e-commerce, if I assume it as urban, then my urban business has grown by 14.5%. So I'm not sure urban slowdown at a 14.5 is definitely not a slowdown. And this is organic. I'm not counting my new acquisitions into the number. I'm doing a like for like, right? So from that perspective, we remain pretty bullish on the overall India trend. And overall also, my gut feel is that we bottomed out in October, November. And from there on, the going has been easier, if I say so. On the valuation front, management's job is not to drive valuation. Management job is to lay very specific targets and deliver against them. I do think we've delivered a pretty good FY25 in the face of what we were given. And we remain focused on making sure whether it is distribution, branding, innovation, digital, all these pieces we remain focused on to deliver. Valuation ultimately is for the street and the investors to decide.
Mr. D'Souza, sticking with the snake in the pipe analogy, hope that it turns a corner very quickly and moves up and the pipe remains straight. Thanks so much for joining us today.
Thank you. My pleasure.
Right, sticking with FMCG, we're talking about HUL. It's, of course, announced its results. We've spoken about it. The management is speaking at a press conference. Let's go across and see what they're saying.
While absolute volume tonnage grew in mid-single digit, it was partially offset by negative mix. We delivered a competitive performance, further strengthening our market share. Gross margin was at 50.3%. EBITDA margin remained healthy at 23.5%, albeit lower 30 bps year-on-year. Profit after tax before exceptional items grew 1%, while profit after tax increased 5% year-on-year, led out of profits received from disposal of Pureit. During the year, we continued on our journey of sharply executing the Aspire strategy to unlock 1 billion aspirations. We have segmented our portfolio into core, future core, and market makers. Our segmented portfolio approach facilitates better allocation of resources to maximize overall organizational growth. In financial year 25, we continue to modernize our core portfolio with relaunch of Lifebuoy and Glow & Lovely, strengthened our market position in future core, and delivered double-digit growth in market makers portfolio. Our focus on transforming our business into high-growth spaces has led to a 200 bps shift from core to future core and market makers. We have accelerated our pace of transformation with sharper where-to-play choices. We acquired a majority stake in Oziva, a health and well-being business, in January 23. The business has since scaled up from an annual run rate of 100 crores to 400 crores. Last quarter, we announced the acquisition of 90.5% stake in Minimalist. I am pleased to inform you that we have completed the closing formalities as of 21st of April 25. We look forward to unlock the next phase of growth with Minimalist, which is now a part of larger HUL ecosystem. Pureit business divestment was completed, unlocking value of circa 600 crores. The demerger of ice cream business is progressing on track with regulatory requirements, and we expect it to be completed by end of financial year 26. In line with our strategy to strengthen business resilience, we announced the acquisition of palm undertaking from Vishwatej Oil Private Industries and announced our investment in Lucro Plastic E-Cycle Private Limited. The former will aid our palm localization strategy, while the latter is a step towards developing flexible plastics circularity. Considering our performance for the year, the Board of Directors have proposed a final dividend of Rs 24 per share, subject to approvals of shareholders at the AGM. Together with interim dividend of Rs 19 per share and special dividend of Rs 10 per share that we announced in October 24, the total dividend payout for this year will be 12,453 crores. Moving on to March quarter 25 results. Underlying sales growth was 3% and with an underlying volume growth of 2%. Gross margin at 49.8% was lower by 160 bps year-on-year. This contraction in gross margin was driven by commodity inflation across palm oil, tea and coffee that wasn't fully priced for. EBITDA margin remained healthy at 23.1%, lower by 30 bps year-on-year. Profit after tax before exceptional items and profit after tax both grew at 4%, including the benefit of interest income on prior period tax adjustment. Coming to performance across the four business segments, Home Care delivered a robust mid-single-digit UVG, which translated to 3% USG as we continue to pass on the benefits of deflationary commodity prices to our consumers. Beauty and Wellbeing grew at 3% USG, led by volume. While Hair Care delivered double-digit growth, Skincare was impacted by mass skin performance. Personal Care delivered 3% price-led growth, while UVG declined in low single-digit. Skin Cleansing, led by non-hygiene segment, continued its positive growth momentum. Oral Care delivered price-led growth. Foods turnover declined by 1% on the back of mid-single-digit decline in volume. Robust performance in beverage, ice cream and packaged food was impacted by performance in nutrition drinks. Margins in all four segments remained healthy, with Home Care at 18%, Beauty and Wellbeing at 33%, Personal Care at 18% and Foods at 16%. Moving to our near to mid-term outlook, we expect growth to gradually improve as a result of our accelerated portfolio transformation actions and improving underlying macro conditions. We anticipate first half of financial year 26 to be better than second half of financial year 25. If commodities remain where they are, we expect price growth to be in low single digit. Gross margin is expected to further moderate due to commodity inflation and our continued commitment to provide consumers with right price value equation. We will step up investments behind our multi-year market-making platforms, channels of the future, and strategic capabilities to successfully land our portfolio transformation. As a result, EBITDA margin will be maintained in the range of 22 to 23%. We believe this is the right time to accelerate investments as we chart the future course of growth for the company in the backdrop of portfolio transformation actions and improving macro environment. With this, we conclude our prepared remarks and I will take questions.
Hi, thank you so much, Dr. Speaking. If I could just quickly touch upon the urban demand scenario, can you give us a little more clarity on how the improvement's been there? Are you seeing any rebound in the urban growth and also a little bit of in the rural demand also? Give us a little more sense on the inflationary scenario also. You said low single-digit price growth is what you're expecting. Going forward also then, how do you see the volume to price mix also changing for the fiscal that we're entering into? And then on the same lines, then how do we look at the margin profile as well?
So maybe I can cover off the broad market shapes and then Ritesh can talk through some of the more nuanced points you asked about the price and mix. So broadly speaking, we've seen market growth subduing over the last few quarters, largely led by urban. Rural, on the other hand, is resilient and robust, and we see that holding up. And we do expect going forwards, macro triggers are positive. We see, of course, the food inflation coming down sharply. We see the interest rates also being reduced. That will impact the EMIs and therefore lots of urban households. The crude oil being softer also does impact the entire economy. The agricultural output is strong. The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro. Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years, and we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future, building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We are operationally quite robust. Our brand powers are strong, getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are the best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'll be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further. So we are being quite active and I would say leaning in aggressively on investing on our business. We believe this is the good time to do that, and it's a very opportune time to invest for the future of the FMCG in this country, which, as you know, is a long game, is a great place to be in.
Right.
So let me just add and pick up the other questions you had. So as Rohit mentioned, both we look at external atmosphere of macro conditions and what we have done internally to drive our portfolio transformation. Put together, there's a pretty strong case for us to further dial up investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. To your question, where do you see the balance between volume growth and price growth going forward? It's a healthy mix as we speak this point in time, but as the year we progress, if commodities remain where they are, volume growth will be ahead of price growth.
Right. But which are these categories, Ritesh, if you could say, where can we expect the price decreases and where can we expect the price increases?
Yeah, so home care is a category which gets largely impacted because of the crude oil. This is where, as we speak, in the quarter we had a negative price, and this is where the momentum of pricing will be negative, unless again the signals of commodities end up changing. And price increase will be essentially in skin cleansing, which is where crude palm oil has increased, and tea category. Of course, tea, I'm very mindful. We are now not in season for tea production, The new crop will come in May and June, and we'll have a different signal, if at all, and we'll determine basis that what happens later on in time.
If you could also just touch upon the margins bit that I was talking about, how do we look at
Yeah, so margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And it will keep helping us to keep driving more amount of investments across the board.
Just to confirm on that,
last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 20 to 23 and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today what we're speaking about that we are lowering that number to a range of 22 to 23 because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
First of all, we don't we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out first of all, then zoom in.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise and dealers are indicating that a preferential issue to the UBS.
Hello and welcome. You're watching KYC. Today we're going to speak and break down a very interesting company. Zaggle is what we're going to try and get deeper insights on. Let's talk about why we're looking at this company and what is it that I'd want to know about this company first off. It's a platform company, and therefore both IT as well as platform is largely how the business can be described. I want to understand whether it's a unique business. Are there deep moats in it? Because when you're looking at the way in which the stock price has moved and how it's currently valued, it's valued extremely richly, and therefore is it a unique business, and are there deeper moats, or can someone come in and replace this business very, very quickly? And if that were to happen, you could well see that as one of the largest risks. Second is with regard to the growth guidance that they've given. They've given, again, very, very strong growth guidances. They've been able to beat it, at least in FY25. Can they continue to do that? Is there upside, downside risk to that? Third is, what's the likelihood of customers staying with the platform? So one is to try and get new customers. That is going to be one concern. The other one is whether the existing customer base will remain with the platform. What is the contract tenure like, and how sustainable is it for the customer to stay back? Fourth is, can margins expand? They've guided for very strong margin expansion. Can they really expand or not? Fifth is there a concern with regard to receivables? Now, why is this a concern? When we're looking at the cash flow, the cash flow from operations hasn't gone up despite profit before taxes rising extremely sharply. That is not a good sign, because that means there are certain receivables sitting in the cash flow statement, which is creating an issue with regard to cash flow from operations. I want to understand whether there is a concern there. And lastly, what are they looking for when they make acquisitions? What's the end goal, and how do they expect and what exactly are they expecting when they're making acquisitions? Is it going to be margin accretive? Are they looking only for geographic growth? Are they looking for product growth? What is it that they're looking for? So all of this we'll try and understand better. Acquisitions, largely the way in which they're deploying cash. So fresh cash largely getting deployed in acquisitions. That's the sum and substance of it. Let's though talk about the company now. Let's talk and let's zoom in to what the company is actually about. First one, it's a fintech plus a SaaS company, right? And I'll break both these terminologies down a little bit better. So it helps businesses manage expenses. So it provides software as a service to businesses. So it's a B2B, 2C company, but mainly a B2B company. It's a business-to-business company. It's the #1 prepaid card issuer in the country. So once they onboard a company onto their platform, they are then able to provide the customer with better products to help manage the expenses of their employees. And that's probably how they do it. One of the ways is through issuing cards. They serve corporates, SMEs, as well as startups, so they have that entire cohort. They have around 3,300 corporate clients at this point. They have over 30 lakh users of their platform, and they have an in-house digital payment technology. Whether this is replicable or not is one of those risks that I was talking about. They were founded in 2011 in Hyderabad. So this is all about Zaggle. Now let's talk about what exactly it does. So it offers prepaid gift credit cards for the employees of their customers. They provide a software for expense tracking for their customers, and it allows customers to provide employee rewards with better ease, automate bill payments, and just manage expenses in a better fashion. They have 4 key products. I mean, they have plenty more, but the Propel Save, the Zoyer, and the EMS are the largest products at this point, with Zoyer growing the fastest in terms of product. Now, I'm going to try and also give you a description of what each of these products do. So Zoyer is the accounting software. So all your vendor payments are routed through Zoyer. That's one of their prime products at this point. They also have Zaggle Propel, Zaggle Save, Zaggle International Payments, Zaggle Fleet Management, and Zaggle Zatix. All of these perform different functions with regard to expenses. One is for reimbursement for employees. One is to help employees make sales. One is for analyzing business expenditure. One is for fleet management, and one is for international payments. So you've got all of these different products which they work with. They have currently over 5 crore cards issued as part of their product stack. And in terms of how it operates, it sells to businesses mainly and not to individuals. It uses automation. There's a current software platform which it sells. It partners with banks, travel firms. It cross-sells multiple products once a customer is onboarded. It helps monitor spending. It's sector agnostic. It has around 400 odd employees in India, and it listed in 2023. So it's a publicly listed company since just about 2023. So 2 years there. Now, in terms of how it helps the customer, it saves business time, money, it reduces errors, it improves cash flow, it offers tax-saving employee benefits. The customer churn is extremely low, it's less than 1.5%. It's a unique business in the fintech space. Can it be replicated is really the question. They do make acquisitions on and off, and currently sits at a market cap of around 4,900 odd crore. So that's how it kind of all stacks up. Currently, trailing 12 months, 1165 crore is the top line of the company. So this is all about Zaggle. Let's now dive deeper into the metrics that we always talk about. And I'll start off first with some of the user metrics and customers that Zaggle has worked with, and how that has grown. If we can quickly pull that up. That's how the total number of users has gone up by. So from just about 9 lakhs, it's gone up to around 31 odd lakhs over the last 4.5 odd years. The total customers also have gone up from 1,092 to around 3,337 in the last 4 years. So you're seeing that kind of inch up with regard to performance metrics and customers, which helps the company grow. We will have Avinash Godkhindi, who's the MD and CEO, shortly to talk to us about how he sees risks play out and what's the guidance like going forward, thereby giving us some bit of color on what to expect and how to value this one. Let's look at the metrics now. Let's talk about the income statement. The growth has been strong with regard to this company. Of course, it's a software company, smaller base as well. So it's grown at nearly a 48% 3-year CAGR in terms of how the income statement has grown. Look at it double in terms of revenue just in the last 2 years. EBITDA also has been phenomenally sharp in terms of its uptick. You've seen EBITDA go up by nearly 37% 3 years. It's fallen a bit in FY23, but we've seen a bounce back in FY24 in terms of EBITDA. The EBITDA margins, which are traditionally higher, have come off because the company is investing in new and newer features within their platform. And now they are expecting a steady inch up in terms of EBITDA margin going forward. But at this point, margins are a shade below 10%. Profitability has been extremely strong. It's up at roughly a 47% CAGR over the last 3 odd years. So it's a thumbs up across the board in that sense. Let's look at the 9-month numbers as well, and we'll get better context here rather than the last 3 years. Just look at the way in which some of those numbers have gone up by. You've seen revenue go up 77% YOY. EBITDA is up 81%. EBITDA margin is up 20 bips or thereabouts, and profit is up 56% YOY on the 9-month period in terms of FY25. Let's switch over and clear thumbs up with regard to some of these numbers. Let's switch over to the balance sheet. It's a low debt company, just about 60 crore rupees of debt. And as I did mention, nearly 5,000 crore in terms of market cap. So I won't talk much about debt, but look at shareholders' equity. Shareholders' equity has gone up over the last maybe couple of years because there have been a couple of fresh issues that they've done. The reserves number has also inched up. And the cash and that may not reflect because there has been a recent fundraise that Zaggle has done. But you look at the cash and bank balance, it sits pretty at 200 odd crore. So you're sitting at a decent level of cash balances. So we'll give this one a thumbs up as well. They're going to deploy cash in new acquisitions, and we'll talk a little bit about that as well. Currently, no risk, at least on the balance sheet. They're doing some bit of equity dilution, yes, but nothing major expected in terms of equity dilution going forward. Let's look at cash flow. And this is where some concern creeps in. While the negative 35 crore cash flow has come down to negative 1 crore, but you've seen, and one of the reasons why there could be a concern here is the receivables have gone up sharply when you're looking at it over the last 2 to 3 years. So the receivables number, because of the sharp inch up, you are starting to see some bit of pressure on cash flow from operations. Can that go away is the question. Can receivables flatten out over the next 2 to 3 years while maintaining that PBT, very strong PBT growth for the company that we've seen over the last 2 to 3 years? And if that were to happen, this will even out. Cash flow from operations will show a solid positive number. Net cash flow, though, still positive because borrowing, which was made in FY24, and equity raise, which has been made in FY25, currently taking care of the net cash flow number. Let's talk about return ratios. Now, again, it's fascinating. The return ratios are on a tapering trend because of the new investments that they've made. This is as per Bloomberg numbers, mind you. The return ratios have come off and therefore something to look out for. A thumbs down. We'll have to wait and watch for those return ratios to bounce back up. Let's talk about shareholding pattern very, very quickly. Now, in terms of the way in which the shareholding pattern has gone, you've seen promoter buying, which is happening here, which is the one key positive, right? You want a company where promoters are interested and wish to buy. Of course, there's been some bit of equity dilution, but promoter buying is the one thing which is positive. In fact, commentary also seems to suggest that promoters will keep increasing their stake in the company, which shows some bit of confidence that the promoters have in the business, and therefore a clear thumbs up. Let's look at the street cred now. The last 6 months or so have been difficult for the company, but the last 1 year returns have still been positive at 26 odd %. So decentish in terms of their 1 year returns. We'll give this a thumbs up. We'll give them that benefit of doubt because the near term has been tough, especially for small and mid cap companies. And this one is within that basket of small cap companies and even in fact one of the smaller ones even within that basket. Now, in terms of outlook, what can we expect? And that's the other metric we're looking at. They're expecting a 63% growth in FY25. Around a 45 to 50% growth is what they had guided for. They've overachieved on that count likely. They've done 77% for 9 months FY25. Mind you, we looked at that number. And therefore, it's a positive with regard to if they are able to continue to grow at this clip. If we look at the way in which customer count has increased, if we look at the way in which all their metrics are lining up in that sense, and how many new customers they continue to onboard, we get regular updates on the exchanges that they have been adding customers on a regular basis as well, and that kind of keeps that confidence that you could see this kind of growth being clocked. Expect margins to go to mid-teens in the next 3 to 4 years. That's at least the outlook that they've given. They're looking at acquisitions, so they're deploying fresh cash into acquisitions. They will use the spare money to buy more companies and to try and grow their market. Now, that's all of that is positive because you would want a fast-growing company to continue to reinvest the money at a higher return ratio. So we'll also have to look at that, whether that return ratio can come back up, can bounce back up. Now, in terms of valuations, and let's break this down. again, slightly more nuanced. And we've, of course, followed the kind of guidance and outlook that management has given to try and arrive at a valuation. The current market cap is roughly 4,800 crore odd. Your FY25 revenue is expected at roughly 1,250 odd crore. The FY26 revenue at a 50% growth clip is expected around 1,900 crore, and the FY27 top line is expected around 2,800 crore. We've not gone beyond that. It's likely that growth may taper because the base gets higher. We'll quiz the management as to what gives them the comfort, if at all any, that growth may actually stay elevated even at those levels. But let's take FY27 as the base year. Now, they've guided that in the next 3 to 4 years, margins will go to mid-teens, so say 15% by FY28 or FY29. So let's assume a 12% margin in FY27 because that will be a journey which they'll take. EBITDA will roughly be at 340 crore. That means that the stock, which is at 4,800 crore in terms of market cap, will be trading at 14 times EBITDA at that point of time. Also, that will mean, let's factor in maybe 20 to 30 crore of interest payments and depreciation, which has largely been the case over the last few years. And therefore your profit before tax will roughly, and of course you'll have to add other income as well. So your profit before tax we've assumed at 320 crore and profit after tax is around 240 crore. So it's trading at a price to earnings multiple FY27 of 20 times. Currently trades at 65 times trailing 12 months. So be careful of that. What the risk could be? Execution, growth and margins. Those are some big factors that we've assumed in as part of our assumptions, and therefore those could have downside risks. And of course, we'll try and get perspective as to whether those risks will translate or not. And we'll speak straight to the management in just a minute. But first off, on the ratings, how does it stack up? Let's pull up the ratings very, very quickly. You have the income statement, balance sheet, thumbs up, very strong growth, cash flow, more to be seen, return ratios, a thumbs down because it's just sub 13% as of now, but you could well see an inch up there as well. With regard to shareholding, street cred, outlook and valuations, no negatives there at all. So 5.5 is what Zaggle gets on our KYC ratings at this point. Let's quickly look and speak with Avinash Godkhindi, who's joining us, co-promoter, managing director and CEO at Zaggle Prepaid Ocean Services. Welcome, Avinash. Good speaking with you.
Good morning.
Good morning. I want to first understand from you what really helps Zaggle stand out in terms of competition. Do you believe that the services that you offer are easily replicable?
Great question, Harshan. It's the reality of these businesses is that there is no one thing that stands out. There's always a combination of factors. And we've also had a lot of luck along the way. So I have to be honest that, if we were to try and set up this business today, it's extremely hard because we have 3 pillars in our business. There's software, there's bank partnerships, as well as corporate relationships. And we believe unless you've all these 3 bases covered, you can't build a profitable spend management business, at least in India. Right? And today, for somebody to come in and try to stitch all these 3 pieces up is incredibly hard because it takes a lot of time and you can't buy your way into bank partnerships or even enterprise contracts. So that's the big moat. The fact that we probably started this business at a little before time, but not too before time, 13 years ago. And at that time, getting the bank partnerships was far easier. Banks were a lot more, it was an innocent phase is how I would call it of the fintech industry, 2011-12. And we worked with banks and we built our credibility. So today we work with 16 banks, all the major banks in the country are partners with us. HDFC, ICICI, SBI, Axis, Kotak, Yes Bank, IndusInd. All the major banks work with us and a couple of international banks, DBS, HSBC. So today, for somebody to come in and try to replicate across these 3 pillars, we believe is going to be extremely hard.
Understood. And what's the likelihood of your customers staying on your platform? I know I've asked you this question before as well, but give us perspective, because we've broken this down from a know your company perspective.
Yes, so look, our historical churn rates for customers is less than 1.5% per year. So customers don't leave us. And there are many reasons for that. One, we have a high quality solution, and it's incredibly difficult to be able to move away once you have a ERP integration, once you have an HRMS integration. There are customers where we have a CRM integration with their Salesforce, etc. So then, the whole ecosystem is a well-oiled machine. Why would you want to move away? Secondly, we are also a partner who brings tremendous value to them. We reduce fraud and leakage, we increase their compliance, we reduce their human capital that gets deployed in mundane tasks. We leverage AI heavily today. We are continuing to do that so that benefit gets passed on to our customers. And they are able to make sure that their teams are more meaningfully used rather than doing mundane reconciliations or checking, receipts, etc. And that is a big value for corporate customers. And secondly, additionally, we are very competitively priced. So that also works in our favor.
Okay, point taken. Now, one thing, Avinash, that stood out for me was your cash flow from operations. It's not going up in the same clip as your profit before tax, which is growing at a very healthy clip. Why do you reckon that's so, and what is it going to take for you to start your cash flow from operations to start turning very solid?
Good question, Harsh. And this is something that we are constantly working on. This is something that's a focus area for us. And we are seeing improvement. You'll see improvement in the full year numbers as well. We track it as a percentage of our revenue. And the reality is the way most businesses operate, you first grow your revenues, then you grow your EBITDA, and then that translates into cash flow. We are in two different, and there is a slight lag there. There's also a fact that we work with large banks and large enterprise customers, and while we work with them to streamline their payout periods, there is certain lag there, and these are receivables largely from partner banks. Some of the biggest banks in the country, like SBI Cards and others. ICICI. So we are working with our partner banks, we are working with our corporates, and I don't need to say much. You can see the improvement from last year to H1, and now the full year for this year. You'll see numbers improve.
Okay, and what are the factors which are weighing it down currently? Is it receivables, and why is that a bit of a tepid number?
See, Harsh, as we raised capital in September 2023, right? We've always historically been cash flow positive. As a largely bootstrap company, you don't have a choice. Otherwise, you don't survive. So the DNA of the business and the organization is to be very cash focused, and we continue to retain that. When we raised the capital, the whole idea was to raise that capital and deploy it to grow and to grow fast. And we've been doing that quite successfully, in my view. In that period, it was bound to be that there would be a certain amount of cash that would get deployed, and that would generate the profits, and eventually, the cash comes back to the business. So that was always the plan, and that's how we've been operating, and we're seeing the whole trajectory move as more or less as we had envisaged.
Okay, point taken. What should we look at in terms of growth? Because you've guided for a 45 to 50% growth clip for at least the next 2 to 3 years. Can we extrapolate that and push it forward by maybe a year or two? And the reason why I ask you is because you've guided for margins to reach mid-teens, 15, 16% in the next 3 to 4 years maybe. And therefore, will be valuable from a viewer perspective as to what the upside or downside risk is to the kind of growth, top line growth guidance that you're guiding for.
So Harsh, we said that we're aiming in the next 5 to 7 years to reach $1 billion revenue. That's our goal, assuming that the dollar rupee ratio stays in a reasonable range, right? But that's what the target is, and we are on track to do that. In fact, if you see last year, we had started off the year giving a guidance in the range of 45 to 55% growth. We've consistently upped that, and we had given a guidance last of 58 to 63% growth. Happy to share that we've looks like we've crossed that 63% mark as well by a bit. So growth has been very strong, simply because market leadership helps you attract a lot more business, a lot more contracts, a lot more traction. And being listed helps because there's a certain amount of credibility that comes to you as a listed entity. And that brings a lot of comfort to our customers and partner banks.
Okay. All right, Avinash. Would love to have quizzed you even with regard to acquisitions, but unfortunately out of time on this one. But thank you so much for joining us, giving us all of that perspective. Great to speak as always, and wishing you all the very best for FY26 and beyond.
Thank you. Thank you so much, Ash.
Right. Right. With that, we're out of time on this edition of KYC. From myself, everyone who puts the show together, thanks so much for watching. Hope this was helpful. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The second buy pick is a Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Markets trade range bound, but in the red. Pharma and metals gain. Realty and FMCG drag the indices. FMCG major Hindustan Unilever's fourth quarter earnings meet estimates. The The company says urban demand continues to be under pressure. Nestle as well came up with their Q4 numbers. Revenue rises 4.5% to 5,504 crore rupees. Net profit, though, slides 6.6% in line with estimates. Pharma major Lupin shines today as a generic version of a drug that treats kidney function is all set to be launched in America. The countdown has begun for Pakistani nationals to leave India. The Atari-Wagah border is closed. The Pakistan government's official handle on X.com is withheld in India, and one soldier is killed in an encounter with terrorists in Kashmir's Udhampur. Hello and welcome. Good afternoon, viewers. This is Malika Mishra and you're watching Markets at 12. Two big numbers. FMCG giants Hindustan Unilever and Nestle have announced their fourth quarter earnings in line with estimates. My colleague Mahima, who closely tracks the space and is at the venue of the HUL press at the moment, is going to tell us more about how these FMCG companies have fared so far.
Right, so Mike, I'll start with HUL first. In terms of HUL, the numbers definitely were in line. Revenue was up 2%. Net profit saw a growth of around 3.6%. In terms of segment-wise growth, home care was up 1.8%. Beauty and personal care was a surpriser where the growth came in at 4.2%. Personal care was up around 3%. Foods still continues to see pressure, down by about 0.3%. The underlying volume growth was at 2%, but the stock actually seeing significant pressure in trade today, and this is on the back of company lowering its margin guidance. The earlier guidance was 23 to 24%, which is now lower to 22 to 23%, and the management has also said that the margins will be on the lower end of the band. Now, in terms of the commentary coming on rural and urban recovery. Rural, they are seeing recovery. Urban continues to see pressure. In terms of Pureit demerger, it has been completed. The growth will gradually be better in first half of FY26 as compared to first half of FY25. In fact, even second half of FY25. Gross margins will further moderate is what the company has said. And overall volume growth will be ahead of pricing growth in FY26 if the overall raw material price ranges remain in the same range. Next, Nestle. Well, Nestle is slightly ahead of what the street was estimating in terms of revenue growth, came at 4.5%. EBITDA came at 3% growth. Margins were a surprise because margins were expected to be lower, but they came at 25.5%, similar to what it was in Q4 FY24 as well. Net profit was down 6%, which was expected to be down around 8%. So a little surprise there. In terms of domestic sales, it was up 4%. Export sales was down by around 8.7%. In terms of management commentary, Q4 saw double-digit growth in both beverages as well as confectionery. Powdered and liquid beverages saw the largest growth and was the largest contributor in FY25 overall. Nescafe has strengthened its position so far. Milk products and nutrition was backed by launches, and pet care business saw high double-digit growth, and this was highest since the integration of this business has taken place. In terms of the comments, business comments coming in from the management, e-commerce has again strengthened its availability. Organized trade saw a strong broad-based growth across category driven by store expansion. Out-of-home continued to accelerate, led by driving penetration across focus channels as well as portfolio. And lastly, export expanded their footprint in Maldives as well as New Guinea, and Maggi noodles introduced new markets in Middle East as well as South Africa. So this is everything that you need to know right now so far that the company has announced for both HUL as well as Nestle results.
Right, Mahima, thank you so much for giving us those updates with regards to these results of two big FMCG giants. And viewers, let's quickly take a look at how HUL as well as Nestle have been reacting to their quarterly results. If we can pull up the HUL chart and see, yes, HUL is down about 3.5%, over 3.5%, and has guided for a better second half as compared to what has already taken place for the company. And let's take a look at Nestle as well. Nestle has recorded an 8% drop in its export sales, and Nestle is down about 1.5% as well. Moving on, viewers, Persistent Systems as well is in focus on the back of their quarterly numbers, and they've come largely in line with estimates, with revenue and profit rising by 6%. My colleague Hiral spoke to Sandeep Kalra, CEO of Persistent Systems, to make sense of these numbers. Let's listen into a slice of that chat.
One stock that is in focus on the back of earnings is a Persistent System. The results have met the street estimates. However, the dollar revenue has seen a sequential growth of around 4.2%. Deal wins have been strong. The con call commentary from the management has also been strong. But let's also welcome in Sandeep Kalra, CEO at Persistent, to understand more. Mr. Kalra, welcome to the show. My first question coming to you is, the street wants to know the kind of growth that you've seen in the fourth quarter. Is that trajectory expected to continue in terms of FY26 as well?
Yeah, good morning, and first of all, thank you for having me. Let me just summarize the quarterly and the yearly thing, and then I can build on it for the future. So as you rightly said, we delivered $375.2 million. On a sequential basis, this is 4.2% quarter on quarter and 20.7% on year basis in growth terms, in dollar terms. Now, if you look at the full year, we achieved 1.409 billion. That gives us 18.8% year-on-year growth. Now, if you look at the last 4 years, our CAGR, compounded annual growth rate, translates to roughly upwards of 24%. If you look at the order book has also been fairly healthy. There are macro headwinds that are there on the horizon, and one only wishes that these tariff-related discussions, the DOGE discussions, and all of these things kind of settled in. And even with the environment being tough, the IT services industry has a good opportunity in terms of helping our customers do the cost optimization part of it. And several of our deals over the last 2-3 quarters also have been cost optimization led. So we are optimistic. We are cautiously watching the macro. But if you look at the order wins, if you look at our growth trajectory, it should bode well for a relative outperformance in the sector going ahead as well.
Mr. Kalra, good morning, and thanks so much for joining in today. It's Puneet this side. I just wanted to, go across the business and just look at the segmental performance as well. While banking, BFSI essentially as a vertical has done decently, I was going to just talk about an emerging segment for you, which is healthcare. Now, across IT majors, we've seen that for healthcare there has been some conservative commentary in terms of what's happening on the ground. If you could just fill us in for you specifically, how is that vertical looking at right now? Is this an opportunity for someone like you who's building on this vertical over the last few years, and now is the time to hit the nail on the head? Anything that you can give us with client commentary? Has there been some delays? What are you looking at the ground?
Sure. So if you look at the bigger picture for Persistent in healthcare life sciences, for us, this has been, if I look at the full year basis, it has been a 33% plus growth on a year-on-year basis. If we look at the vertical for the last 6 quarters, this has been the vertical that has been kicking in high gear for us. And for the last quarter itself, if you look at it, the quarterly growth was led by BFSI, which was 5.9%, high tech and emerging on a quarter-on-quarter basis was 5.2%, and healthcare was 0.6%. Now, a number of the initiatives that, if you look at the DOGE side of it, the US aid side of it, and so on and so forth, they are basically clamping down on the spend that is there in certain parts of the ecosystem, the government funded payers, the research organizations that do a lot of clinical research, and otherwise the spend in the human health services and so on. So there's a bit of clampdown there that may impact the growth rate for certain quarters. But overall, if I look at the entire ecosystem across scientific instruments, medical devices, pharma, payer and provider, we are reasonably confident over the year it will pan out in terms of good growth for overall the industry and for Persistent within that.
Mr. Kalra, if you can also just comment on, a lot of the upcoming healthcare as well as vertical companies in the US as well as the developed economies, there was a lot of funding essentially from, agencies as well as governments, and we've seen, like some pressure there, at least in the US from DOGE coming in as well right now. What is happening with those kind of companies? Is it, that the spending for them specifically has now been delayed because they are largely funded by the government, and anything that you can fill us in at least in that aspect?
Yeah, sure. So you are on the right track. There is a significant amount of cut down that has happened on the research organizations. So, for example, various universities in the US, they were conducting clinical research, not only in the US, but even in countries like India, that was funded by the government through US aid or other funding programs. That has been clamped down. There is a certain impact of that on the full value chain. So if, for example, these universities or NGOs were conducting, let's say, clinical research, they were consuming the products from scientific instruments and diagnostic companies, they were buying software from enterprise software companies and so on. So it does have a ripple effect, but over a period of time, all of this should settle down. And overall, if you look at the US economy, The healthcare spending is a big part of that. And this is a secular spending. People need healthcare in a good economy or bad. So this sector will settle down with these adjustments, and it should, in a few quarters, come back to reasonable growth for all of us.
Right. Mr. Kalra, then overall, if you have to look at the tariff impact as well, let's take sectors like communication, energy, utilities, manufacturing, logistics, retail. All of this put together, would there be pressure on any of these segments, and in turn, there could be a risk to the kind of targets that you have for FY 26-27?
Sure. So first, a clarification for you and your viewers. The three major segments for us are tech, followed by BFSI, followed by healthcare life sciences. We don't have a big play in manufacturing or in retail or in energy, utilities, and so on. Having said that, even within the sectors that we play in, if there is a cost pressure, that's another reason for our customers and prospects to work with us to contain the cost, both by offshoring and by using the platforms that we have built on AI part, which can help do the same work for lesser expense. So we have a software product engineering / application development maintenance platform called SASVA. So overall, even if the cost pressures kind of go much bigger from where we are, that should bode in a reasonable way well for us, helping our customers and prospects optimize for the newer regime that may exist in the newer kind of tariff or other scenarios.
A follow-up with all of this is in terms of the kind of discretionary spends, client spends that you're looking out for. In terms of a conference call, you categorically mentioned that things have been fluid. However, you've not seen any cancellations in terms of orders or deals. There is a slowdown as of now. How would you want to explain that to the viewers and investors? I mean, slowdown in terms of deal wins or slowdown in terms of spends, in terms of execution? How would you want to put that?
So the slowdown is in decision making for the forward looking part.
Okay.
Every company has a business to run. Whether you are in whatever sector, small or big, you're serving your customers, you're trying to become better compared to competition and so on. So you don't stop running your companies. You look at discretionary spend, which is a good to have spend. And we have very clearly said that Persistent is not necessarily, a discretionary spend oriented company. When the going is good, yeah, we do help our customers in their revenue enhancement initiatives. And when the going is not good in terms of the macro being tight, we are right up there in terms of, helping our customers with the cost equation, whether it is doing vendor consolidation, more offshoring, bringing more technology to optimize for processes using AI or otherwise. So we are fairly confident, whether it is a good, upturn in the economy that happens over the next several quarters, or even if it remains soft, we are confident of growth, which will be a relative outperformance to the industry. And as I said, in the last 4 years, if you look at our CAGR, the compounded annual growth rate, it's upwards of 24, more like 25% plus, whereas the industry has grown less than 8% in the same, CAGR parlance. So we are relatively confident. Good or bad macro, we'll adjust and we'll work closely with our customers to deliver value to them.
Mr. Kala, just one question, on which we've seen in deal wins as well as, your clients which are over 5 million. Now, if I see FY24, and you highlighted this in the presentation as well, your count for more than 5 million clients went from 38 to 40 in FY24 in the 4 quarters. In this year, it's gone from 41 to 55. What has been one of the key changes in this aspect? And I'm sure there has been work going on over the last 5 years on this, but specifically, is this largely in BFSI that the 3 segments that you highlighted in, and what can we expect over the next, at least the next 3 to 4 quarters on the large client deal additions?
Yeah. So if you look at the last several years, and just building on what I said earlier, our compounded annual growth rate has been in range of 25% for the last 4 years. The industry has been growing at less than 8%. What that means is we have been garnering market share from our competitors for the new business that is outsourced or the renewals that are happening. That is clearly reflected now, tied up with what you just said. Our count of customers greater than $5 million has increased. Our customers greater than $75 million, we have 4 customers today, as compared to an year back where the number was lesser. So overall, we are getting market share, gaining market share against our competition, both from our capability perspective, whether it is GenAI led or otherwise. GenAI revenues are about to pick up. It is also leading to a lot of data modernization projects. So overall, the capability led growth that we have, and our customers, based on our quality of delivery, they're giving us more business. All of that is there. Now, we don't give forward-looking guidance, but if you were to extrapolate our last several years' growth and the order book that we have given, it should bode well for us.
Last question, Mr. Kalra, coming from my side is, 8 quarters to reach the $2 billion mark is what you're seeing. $5 billion in terms of revenue by 2031. A 250 basis point margin improvement by FY27. To achieve these three, yes, you will see acquisitions that could come your way as well in the BFSI space. What is the kind of timeline that you're looking at, number one? I'm sure you're not going to speak to us about what are the potentials, but the timeline and the size of the acquisition that could be in the offing from a Persistent and any other segments that will drive growth.
Sure. So first of all, let me work the things on the margin side first for you. So if you look at the full year, last year, if I look at FY24, we were at 14.4% range, 14.4 to 14.5. This year, full year, we were at 14.7, but our exit quarter was at 15.6%. That bodes very well for us because that gives us a starting base of 15.6%. So on a full year basis, we are already having a head start on margin improvement. If we keep the operational discipline, if we grow consistently, then margin should give us the uplift that we want directionally towards where we want to build. Second, if you look at where we delivered the Q4, we delivered $375.2 million. You multiply that by 4, it is $1.5 billion. Halfway, we are already there. We have 2 years. Last 4 years, CAGR is 24%. Even if we were to deliver lesser than that, the $2 billion is line of sight, give or take a quarter here or there. That is the second part. Third part, we have never said about any acquisitions. So I don't know where you got the BFSI acquisition, but we have just said our acquisition strategy is threefold. We want to expand in Europe. We may do a reasonable size acquisition in Europe. We want to build on our capabilities, whether it is AI, Gen AI, or otherwise in domains in our verticals that we play or sub-verticals. Within the US, that is the second part. And third part, there are horizontal use cases like the contact center acquisition we did with Starfish. So those are our acquisition criteria. We are at any point in time evaluating acquisitions. If there is anything, we'll come to you and to your viewers and announce. So that is where it is. And we are reasonably confident within our organic and inorganic part. The $2 billion is line of sight and we'll build it up to 5. We have 5+ years to deliver to it. And we are, if you look at our history, track record, we are confident we'll get to there.
And that was Sandeep Kalra's commentary on the performance of Persistent Systems. Let's now take a quick look at the markets. The Sensex and the Nifty snapped a 7-day winning streak to open a bit lower this morning. The Nifty 50 has been trading in a limited range with cuts of about 0.2 to 0.3%, but maintaining to be above 24,000 levels as we speak. The 30-pack Sensex dropped from 80,000 and is now hanging around 79,700 levels, in fact 800. The broader markets appear to be outperforming the benchmark indices, with the Nifty Small Cap 250 showing some more strength than the Nifty Mid Cap 150. If you look at the top contributors to the current pressure on the index, you'd see a couple of banking names like ICICI and HDFC dragging the Nifty 50 basket by over 30 points. HUL too is among the big losers as it may be reacting to the subdued quarterly numbers. Bharti Airtel and Reliance too are seen to be adding to the overall drag. On the other hand though, ITC, Infosys, Indusin, Grasim and Ultratech are contributing to the gains. Let's take a look at the sectoral picture, and we see more reds than greens definitely, with realty, FMCG, consumption, rural, finance and auto as the top sectoral losers. In fact, only pharma, IT and metal seem to be happy and gaining. And since we're entrenched in the results season, there are some significant stocks reacting to their quarterly results. Let's begin with checking how Persistent Systems is doing, since we also interviewed the management. The company reported a 6% increase in its net profit, and the stock is up about 2% in trade today. Let's also see how Nestle is reacting to its 4% dip in net profit. And yeah, again, it's flat now. Let's also look at Tata Consumer, as the company's fourth quarter margins took a beating due to higher tea costs, and that's about 0.86% high in trade. Lastly, let's also get a sense of the market breadth, and the advanced decline ratio currently stands highly skewed in favor of the bulls, with about 1,300 stocks advancing. Now, moving on, Vascon Engineering, Popular Vehicles and Panacea Biotech and NHPC are in our radar on the back of order wins and project development. Let's go across to my colleague Mihika for more details on each of them.
I'll start off with the Vascon Engineers. It's received a letter of intent worth 225 crores, and this is an order from Royal Rights for the construction of 2 terminal buildings in 2 different sites, development sites in Goa. The work is expected to be completed within 36 months. The second stock is a Popular Vehicles and Services. The arm has actually received 4 letter of intents to set up Ather 3S facilities in Maharashtra, and this expansion signifies the company's entry into a new state along with Ather, and this facilities will have warehouse and service centers as well, and operations of the facilities are expected by Q2 of FY26. Then we have Panacea Biotech, which received an additional award from UNICEF worth 44 crores. This award is to supply 40 million doses of bivalent oral polio vaccine, and it's key to know that the company had already received a 127 crore order from UNICEF for the same vaccine supply in December of 2024. So now the total supply of vaccine that the company will be doing will be of 155 million doses to the UNICEF. And lastly, you have NHPC. They've approved the development of a 1,200 megawatt solar park in Uttar Pradesh, and this will be developed by NHPC's JV subsidiary. The estimated cost of the project is around 796 odd crores, and this includes an equity investment of almost 240 crores.
Right. Thank you so much for that, Megha. Let us now focus on Rallis India. They came out with their earnings report yesterday, and their fourth quarter revenue was marginally down by 1.4%, and the net loss stood at around 32 crore rupees. We will speak to Gyanendra Shukla, MD and CEO of Rallis India, but before that, Varsha is joining us to set it up.
Thank you for that. So, weak set of numbers that the company has seen. Let's see the key highlights why a company has seen these weak numbers. If you see, volume and margin pressure in export market has actually impacted Q4 performance, and the EBITDA loss that the company has seen is led by pricing pressure in the domestic crop care business. Though there was a volume growth in domestic crop care business, but the pressure in pricing has actually impacted this business. The net loss that you're seeing is led by the lower EBITDA that the company has seen. If I were to talk about the numbers, the revenue was down 1.4%, and there was an EBITDA loss of 20 crore, and the net loss, if you see, was at 32 crore versus loss of 21 crore last year. So the key interesting points here to look at in future is how will export market will be recovered, and also the domestic crop care business, where how will be the improvement when it comes to the pricing pressure that the company has seen, and because of that the numbers have been subdued. So these are the 2 key things which which investors have to watch out in future.
Varsha. Now, we've also heard that pharma major Lupin received an approval to launch a new drug in the US. In fact, the stock is also upward of % today. Could you give us more details on what this drug is and what are the estimated sales from this drug?
Launched G-tolvaptan today in the US, which is a generic version of Jynarque. Now, if you see, they've already received the tentative approval for this product in 2023, and for this now the Lupin will get 180 days exclusivity post-launch of this product. Now, Lupin is the exclusive first to file for this product, and the potential FY26 revenue opportunity is estimated at $150 to $200 million. Now, this product will be manufactured at Lupin's Nagpur facility in India, and the tolvaptan, if you see, is used to slow kidney function, and these tablets had an estimated annual sale of almost $1,467 million in US for year ended December 31st, 2024.
Okay, thanks for that, Varsha. And viewers, that's all the time we have on the show, but do stay tuned to NDTV Profit, as there's a lot more lined up for you right on the other side.
biggie. That is a biggie. It's out of it.
गोल्ड क्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Hello and welcome. You're watching Profit Buzzers. I am Puneet Zaveri, and let's take a very quick look at how the markets are doing. We've seen, some downward pressure on the Nifty as well as, across the mid caps as well. Let's pull up the Nifty first and look at how the index is now faring. Down about 72 odd points. The day's low is almost 24,213, and we are trading in a very narrow range of about 100 points from the day's highs as well of 24,347. Let's look at the top contributors as well to the Nifty and look at what's benefiting it on the upside as well as on the downside. We're seeing some pressure on ICICI Bank today. The banking as well as the IT index was one of the most forefront contributing index yesterday as well as across the stocks that we've seen, both the Nifty as well as on the mid caps. Today seeing some pressure. HUL after the company's results as well as press conference has been a dampener, and we look at it in this particular show as well. While Bharti Airtel also seeing some pressure on the positive side, while not much to talk about, we are seeing IndusInd as well as Ultratech. Let's also look at the sectoral indices as well and see, we might of course see the banking sector under pressure, but Nifty Realty is also the biggest loser today, down 1.4%. FMCG, of course, after Nestle also came out with its earnings today, has been in the downward pressure. While Nestle's earnings were largely, in line, I think the commentary is what's dragging the stock down today. While on the positive side, seen some action across, some pharma names today. We'll be discussing those, Lupin being one of them. Nifty Pharma up almost 1.3%. Let's also look at the mid cap as well as the small cap indices. If we can, if we can see if it is actually outperforming the benchmarks, not so much. Just absolutely flat in terms of the mid cap 150 with a tinge of red. The small cap as well will likely be similar. Not really. It's up almost 66 points right now. Some solids there. Let's also finally look at the BSE 500, see how the stocks are faring today. And we've seen a bunch of earnings being reported today. And while, something like Sonata Software is up 12%, despite the company coming out with a warning for Q4 that they are expecting a higher decline in terms of revenue of more than 3.5%. We saw the stock tank last week. Seeing some, forward buying today, I think potentially because of persistent system and its results. Divis is also up 6% after the Citi note, and we'll talk about that in the show as well. On the other side, a lot of pressure on stocks like Syngene International, another one which is buzzing on the back of earnings as well for the company, and the guidance being one of the key dampeners. Macrotech also down, but Sterlite Tech is also down 25% in trade, amongst others, seeing some pressure on Amber as well. But let's welcome in Prashant Apse as well, the Senior Vice President Research Analyst at Mehta Equities. Prashant, welcome to the show. Thanks so much for joining, and a very good afternoon to you. How are you seeing currently? Let's start off first with the Nifty Bank, because we've seen very positive buying flows across the last week and this week as well, led by the earnings from ICICI as well as HDFC. Seeing some cuts in trade today. What do you see? What is your view specifically on the banking stocks?
Yes, good afternoon, Puneet. Yes, from last 7 days, there have been a continuous rally in the market, which was led by banking stocks. And now I think there is some kind of profit booking attempt seen in those sector. So I think going forward, again, one should focus more on the PSU set of banks, which will be delivering their results very soon in the coming weeks. Private banks have done well with respect to HDFC Bank as well as ICICI as well as Axis also. I think so. More focus would be on the PSU bank, but there is some kind of profit booking attempt seen in the banking space. But again, IT and pharma, those two sectors again are taking care of the market's volatility right now.
Got the view, Prashant. But let's also look at the FMCG, and let's pull up HUL as well as something like a Nestle. Which has been, HUL seeing a negative downtick post its results, but these two giants have come out with this Q4 earnings today in the morning. Let's bring in my colleague Mahima, who was at the venue of the HUL presser. Mahima, tell us more about how the FMCG companies have fared in Q4.
I'll start with HUL first. In terms of HUL, the numbers definitely were in line. Revenue was up 2%. Net profit saw a growth of around 3.6%. In terms of segment-wise growth, home care was up 1.8%. Beauty and personal care was a surpriser where the growth came in at 4.2%. Personal care was up around 3%. Foods still continues to see pressure, down by about 0.3%. The underlying volume growth was at 2%, but the stock actually seeing significant pressure in trade today, and this is on the back of company lowering its margin guidance. The earlier guidance was 23 to 24%, which is now lower to 22 to 23%, and the management has also said that the margins will be on the lower end of the band. Now, in terms of the commentary coming on rural and urban recovery. Rural, they are seeing recovery. Urban continues to see pressure. In terms of Pureit demerger, it has been completed. The growth will gradually be better in first half of FY26 as compared to first half of FY25. In fact, even second half of FY25. Gross margins will further moderate is what the company has said. And overall volume growth will be ahead of pricing growth in FY26. If the overall raw material price ranges remain in the same range. Next, Nestle. Well, Nestle is slightly ahead of what the street was estimating in terms of revenue growth, came at 4.5%. EBITDA came at 3% growth. Margins were a surprise because margins were expected to be lower, but they came at 25.5%, similar to what it was in Q4 FY24 as well. Net profit was down 6%, which was expected to be down around 8%. So a little surprise there. In terms of domestic sales, it was up 4%. Export sales was down by around 8.7%. In terms of management commentary, Q4 saw double-digit growth in both beverages as well as confectionery. Powdered and liquid beverages saw the largest growth and was the largest contributor in FY25 overall. Nescafe has strengthened its position so far. Milk products and nutrition was backed by launches, and pet care business saw a high double-digit growth, and this was highest since the integration of this business has taken place. In terms of the comments, business comments coming in from the management, e-commerce has again strengthened its availability. Organized trade saw a strong broad-based growth across category driven by store expansion. Out-of-home continued to accelerate, led by driving penetration across focus channels as well as portfolio. And lastly, export expanded their footprint in Maldives as well as New Guinea, and Maggi noodles introduced new markets in Middle East as well as South Africa. So this is everything that you need to know right now so far that the company has announced for both HUL as well as Nestle results.
Well, Mahima was actually also there at the press meet post the company's Q4 earnings for HUL. And she also asked the management about the company's margin trajectory, growth guidance for various segments going forward as well. Listen into that chunk of the conversation.
Last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 22 to 23 and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today, what we're speaking about, that we are lowering that number to a range of 22 to 23 because we believe now is the right time for us to dial up further investment to drive growth.
Okay, and in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
First of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out first of all, then zoom in. On zooming out, this is a market that premiumizes. In the long term, people are upgrading. They quality of life, they want better products, and I'm not talking of extremely privileged or luxury products, but people climb up to a better quality of product and experience at every level. That trend is secular. We do see that trend continuing this quarter and last quarter, although it's compressed a little bit. So instead of premium going much faster, it's sort of come down a little bit, but it's still faster. So there is a general upgradation trend, although it's muted compared to the past few quarters. We must not make too much of it and stick focused on the long term, because eventually the market has upgraded, we upgrade. We are a very, very low per capita consumption market at this point. Right. So that's number one. On the pack sizing, the large packs still are growing a little bit ahead. There is a trend towards downsizing. People are probably managing their budgets. Of course, as rural is growing now in the last few quarters ahead of urban, and rural consumption generally tends to be on the low pack size. That also weighted average makes an impact. So there are these twists and turns, but I would not overly focus on them. I think the market in all categories is at a very low per capita consumption, and market development is the main thesis of growth. Innovation, improving quality of our products, getting people to use something more better is the main thesis of growth in this market, and we stick to that in medium and the short.
Right. And any guidance with respect to growth where Minimalist is concerned, because beauty and personal care has done very well this quarter. What are the kind of targets that you are looking at right now?
See, we had mentioned as we acquired the business now, we completed the whole transaction 21st of April. We are very focused to unlock both growth synergies and cost synergies. Leveraging the R&D entire process and capability that we have as Hindustan Unilever, we will benefit the business of Minimalist with that. Our supply chain network of production capacities and our expertise in that space will end up giving synergies to Minimalist business. We will also aid international expansion of the business. And last but not least, Minimalist is by and large an online brand, and we'll end up leveraging the offline distribution. So these are the four elements of synergies with which we will now start running the business, and we'll keep you updated in times to come how those synergies are going to look like. But we are very optimistic. It's a fabulous brand, very well positioned in the masstige skincare category, and we do believe now within the family of Hindustan Unilever, it will have a very bright future.
Well, that was the management of HUL. But Prashant, let me come back to you. What is your view specifically on HUL as well as Nestle? Do you see that while the companies have pointed out to some course correction, is this a good time to get into these stocks?
Firstly, the numbers were largely in line with our expectations also. We were not expecting any margin improvement in the stock. We know the costs were really high and there was some kind of commodity prices very high and which has hit their margins obviously. But again, the commentary from the HUL was little bit surprise for the market and hence the price is showing some kind of correction of almost 100 rupees from the day high. But if you see the right level to buy, I think one should wait and watch. Again, 2200 can be a level where I'm expecting some kind of good level to start buying this stock for a long-term investment. But overall, again, a wait and watch strategy should be maintained. We need to watch how Q1 earnings will turn out to be once the consumption story comes into a volume driver for FMCG stocks.
Well, let's stick with the FMCG theme for now because Tata Consumer's fourth quarter earnings were also announced yesterday and they were largely in line with what the estimates were, and we also caught up with the management MD and CEO of the company, Mr. Sunil D'Souza, this morning, and he explains why margins were under pressure in this quarter. Listen in.
The street has looked at the numbers. A lot of people, a lot of analysts already saying that the numbers were in line with their expectations. But some of the details that you've already disclosed in terms of the implication of inflation in tea, how much has been passed through in terms of price increases, and what the mix is in terms of the volume. So let me start with that. Seemingly, there's a pickup in demand in the lower end of the spectrum. Do you expect that that's the trend that will continue heading into the new financial year as well? Or do you see a slight change in that as consumption picks up?
So a couple of points on that. I mean, first of all, I think we were quite pleased with the results that we declared. In fact,